What if you suddenly had $250,000? For most people, it's a life-changing amount of money. It's the kind of number that turns daydreams into real possibilities. But what does having $250,000 actually do to your financial life? It's not just about having more money to spend. It's about a fundamental shift in how you think, how you plan, and how you build your future. This isn't just a number, it's a trigger that forces you to make decisions you've never had to consider before. And how you handle those decisions will determine whether that $250,000 becomes the foundation of true wealth or a source of stress and regret. First, let's talk about the most immediate, practical change that happens when your savings cross that $250,000 threshold. You hit the FDIC insurance limit. The Federal Deposit Insurance Corporation protects your money in the bank, but only up to $250,000 per depositor, per institution. The moment your balance tips over that line, every dollar above it is technically uninsured. If that bank were to fail, you could lose that extra cash. This forces your first big decision. What do you do with the overflow? Do you spread it across different banks? Do you open a joint account to double your coverage? Or do you finally move that money out of a simple savings account and put it to work? This is where the real journey begins. It's the first step away from just saving and toward strategic wealth building. Now, let's get into the really exciting part, the power of compound growth. There's a reason financial experts say that $250,000 is halfway to a million. It's not just a catchy phrase, it's a mathematical reality. If you invest that $250,000 and earn a 10% average annual return, which is the historical average of the stock market, it will grow to $1 million in about 14 years, without you adding another penny. That's the magic of compounding. Your money starts making money, and then that money starts making even more money. Let's put this in perspective. If you left $250,000 in a high-yield savings account earning 4%, in 20 years, you'd have around $548,000. Not bad, but if you invested it in the market, that same $250,000 could become over $1.6 million. That's $1 million difference. This is the crossroads you face. Do you choose the comfort of cash or do you embrace the power of growth? Your answer to that question will define your financial future. But with great opportunity comes great psychological pressure. Suddenly having a large sum of money can trigger what's known as sudden wealth syndrome. It's a real phenomenon that causes anxiety, stress, and poor decision-making. You might feel an intense pressure to do something, anything, with the money. This can lead to impulsive emotional choices, like buying a luxury car you don't need or investing in a risky venture you don't understand. You might also feel a paralyzing fear of losing it all. This fear can be so strong that it pushes you to do nothing, leaving your money to be eaten away by inflation in a low-yield account. It's a tug-of-war between the fear of missing out and the fear of losing everything. Understanding this psychological battle is the first step to winning it. You have to separate your emotions from your financial strategy. This is where your mindset becomes your most valuable asset. Wealth isn't just about the numbers in your account. It's about how you think about those numbers. People who build and maintain wealth have a different mindset. They see money not as something to be spent, but as a tool to be used, a tool to generate more income, to create more freedom, and to build a legacy. They don't ask, "What can I buy with this money?" They ask, "How can I use this money to build the life I want?" This shift in perspective is crucial. It moves you from a consumer mindset to an investor mindset. It's the difference between thinking about what your money can do for you today and what it can do for you for the rest of your life. So, what are the practical steps? How do you navigate this new financial landscape? The first step is to pause. Don't make any sudden moves. Give yourself time to adjust to your new financial reality. The second step is to educate yourself. Learn the fundamentals of investing, asset allocation, and risk management. You don't need to become a financial genius, but you do need to understand the basic principles of how to make your money work for you. The third step is to create a plan, a real written financial plan that outlines your goals, your timeline, and your investment strategy. This plan will be your roadmap, your guide to making rational, informed decisions instead of emotional, impulsive ones. When it comes to investing your $250,000, diversification is your best friend. Don't put all your eggs in one basket. A well-diversified portfolio will typically include a mix of stocks, bonds, and real estate. For someone in their 30s or 40s, a common allocation might be 70 to 80% in stocks for growth, with the rest in bonds for stability. You can achieve this diversification easily through low-cost index funds or ETFs. You might also consider real estate, either through a direct property purchase or through a real estate investment trust, which allows you to invest in a portfolio of properties without the hassle of being a landlord. The goal is to build a portfolio that aligns with your risk tolerance and your long-term goals. It's not about chasing quick wins. It's about building sustainable, long-term wealth. One of the biggest changes that comes with having a significant amount of money is the need for professional guidance. When you're just starting out, you can often manage your finances on your own. But with $250,000, the stakes are higher. The decisions are more complex. A good financial advisor can be an invaluable partner on your journey. They can help you create a financial plan, build a diversified portfolio, and navigate the complexities of taxes and estate planning. They can also act as a crucial emotional buffer, helping you stick to your plan when the market gets volatile and your emotions are running high. Think of a financial advisor not as a cost, but as an investment in your financial future. Having $250,000 is a major milestone. It shows your hard work and discipline, but it's not the destination. It's the starting line. It's where your financial life moves from defense to offense. It's where you stop just trying to get by, and you start actively building the future you've always dreamed of. The decisions you make now will have a ripple effect for decades to come. So, take a deep breath. Acknowledge the opportunity you've created for yourself. And then, get to work. Create a plan. Build a portfolio. And most importantly, cultivate a mindset of a long-term investor, because that $250,000 isn't just money. It's the key to your financial freedom. If you found this video helpful, make sure to subscribe to Frankie Finance, give this video a thumbs up, and share it with someone who is serious about their financial future. And I'd love to hear from you in the comments. What's the first thing you would do if you suddenly had $250,000? Thanks for watching and see you in the next video.